Hi, value investors. Welcome to my channel. Today, I'm going to talk about the different books that were part of my career to become an investor. And you know that I started in this career in the year 2016 when I was looking for something like an infrastructure in my mind, something like an investment philosophy. And in that search, I could find in a really interesting group of books that truly helped me to become an investor. I mean, I wanted to make different investment decisions in the stock markets, and I wanted to make decisions in business with gaining so much confidence. So I needed really, truly an investment philosophy behind all those decisions. And all these books truly helped me to know more about the value investing philosophy. So the first book that I want to share with you is this book. This is the Spanish version, but really in English is The Real Warren Buffett, Managing Capital and Leading People, written by James O'Loughlin here. Okay, well, in this book, this is a really easy to read book in which I could find interesting concepts about the margin of safety and how to build up my circle of competence. So really, this was my first book in which I knew something about Warren Buffett and Charlie Munger and Berkshire Hathaway. And thanks to this book, of course, I could know more about Benjamin Graham. So really, this was my first book in really that helped me to embrace the value investing philosophy in my career. So really, I would recommend this book to anyone who is starting in this career, anyone who wants to know more about the value investing philosophy. You don't need to read, of course, as your first book, the Security Analysis on Intelligent Investor. Of course, I read all these books, but they were not my first books to be introduced in this investment philosophy. So really, thanks to this book, I could learn important things respect to the how Warren Buffett take decisions to invest in the stock market or to make acquisitions of wholly owned companies. And of course, something that I was impressed is how he really truly deals with his managers of all the subsidiaries that are part of Berkshire Hathaway's conglomerate. And there is a strong governance instilled by Warren Buffett and Charlie Munger. So really, I wanted to know more about how Warren Buffett truly instilled this kind of governance, or what are the kind of behavior that he was rewarding with his special compensation packages in all the different companies that were part of Berkshire Hathaway. And something that I was impressed about this book is the fact that I could learn more about the insurance business in general. I mean, I could learn that the insurance business within Berkshire Hathaway are an important source of funding at a cheaper cost. And the reason why these are an important source of funding at a cheaper cost is because they have a discipline instilled by Warren Buffett to set adequate prices for the coverage of particular events. If they don't reach an agreement with the customer to set an adequate price for all those coverage, they won't sign any agreement at all. And that's why most of these insurance business could show poor results in the short term or negative results, but they don't care about that because they are thinking in the very long term, really, in the sustainability of the business and in the sustainability for Berkshire Hathaway as an important source of funding at a cheaper cost. This is a completely different way of thinking if we compare with other insurance business that are not part of Berkshire Hathaway. So this is the kind of thing that I learned about the sustainability of the insurance business of Berkshire Hathaway. And of course, thanks to that, I could learn more about the insurance business in general, and I learned how to assess the insurance business if I want to invest in some of them. And probably most of the time, I look for the values, at least some of the values that are instilled by Warren Buffett in his insurance business, and I like to see if most of the insurance business that I'm looking for have at least some of those core values in their businesses. And that's how I really think this book really, that I've learned more about the insurance business in general here. Well, the second book that I want to share with you is this book, The Lessons of Warren Buffett, The Essays of Warren Buffett, Lessons for Corporate America, written by Lawrence Cunningham here. Well, this is just a copy. I couldn't resist the fact that I could download it from a certain website that I don't remember where, but you can search in Google and you can find this book really completely. And but I would recommend that it is really worth to buy this book because you will find so much savviness in all its pages here. And well, the thing here is that there's so much discussion in this book respect to different aspects like the governance, all the transactions in which Warren Buffett was involved in the years 1980s, 1990s. In fact, this is a book in which, well, this is a compilation of the annual reports written by Warren Buffett to the Berkshire Hathaway shareholders from the 1990s, because this book is from the year 1997. So probably you would find this book outdated, but it's not really, because there are so much things that could be applied even until nowadays. I think that the thing that makes this book unique is the fact that Warren Buffett was a really active investor in those years. I mean, I'm talking about the years 1980, 1990s. And really, you will discover that Warren Buffett not only was involved in the buy and hold strategy of outstanding companies with huge moats, buying an adequate price. Not. He was not only in those kind of transactions, he was involved in different other transactions, more complex transactions, for example, buying preferred stocks with the options to convert them into shares, convertible bonds, corporate bonds, junk bonds or high yield bonds, zero coupon bonds, and so forth. So you will discover that in all the kind of transactions, Warren Buffett deal with the high uncertainty. So probably most of you would think that he was speculating, but he was not, because he was in an adequate way. He was calculating an adequate risk reward and always applying the margin of safety that he learns from his master Benjamin Graham. So really, in this book, you will find different discussion with respect to the accounting terms and how there are certain limitations in the use of the accounting rules to portray the financial situation of a company like Berkshire Hathaway. So really, this is a really interesting discussion. There's other kind of discussion with respect, for example, of the usage of the stock options. I mean, in those years, it was common that many companies use so much stock options to reward the managers without so much meaningful results for the shareholders of those companies. So Warren Buffett criticized that in order to align with the interests of the shareholders, these stock options need to be included as part of the income statement. And there was, of course, so much resistance by the managers in those years to include that stock options. But of course, this is a policy that was applied gradually over the years. And right now, there are so many companies that are applying this policy, which is something that is really aligned with the interests of the shareholders. Other important aspects that I discovered in this video, well, there are some cases that are mentioned by Warren Buffett in which some of the subsidiaries of Berkshire Hathaway truly knew how to construct a compensation package really truly specialized to reward a particular behavior that these companies were expecting of their workers. So really, this is a really interesting matter that you will find so much interesting here. And well, there are other important aspects. So, for example, Warren Buffett discusses the why so many companies in the year 1980s, 1990s were using so much the leverage payout to make acquisitions. You know that the leverage payout is when a company want to make an acquisition asking the loan from the banks, and this loan will be paid back by the acquiree, by the company recently acquired. So really, this kind of situation truly triggered bad incentives in the system, because most companies in those years, in the years 1980s, 1990s, were keen to make more and more acquisition, and that was not in the best interest of of their respective shareholders. And that was because most of the managers wanted to enlarge his power, wanted to see how their bonuses increases, and of course, that was something really bad for the shareholders. And this is the kind of things that Warren Buffett criticized about the leverage payout. So you will learn so many things about this book. I truly recommend it. This was, of course, my second book after reading the first one that I just shown to you. And I found it really, really interesting to help me to become a better investor. So the third book that I want to share with you is the Buffetology, written by Mary Buffett and David Clark here. And well, this is a really easy to read book in which, well, you will find useful information. Probably most of the information in the first part of this book, you already know about all of that information with respect to Warren Buffett and his investing style. But in the second part of this book, there are important things to notice here because, well, I could learn, for example, one of those techniques proposed by this book is your calculation of your compound annual returns given the price you want to pay for a certain stock. So really, with that technique could be seen as an alternative or your calculation of the intrinsic value using the DCF, for example. So really, if you don't feel confident, so much confident using the DCF to calculate your intrinsic value, and you want to know if a certain stock is expensive or cheap, you can use this technique to know if that stock is cheap or expensive. For example, the current price of Apple, for example, is something like $140 per share. So using this technique, we are assuming here we are just launching a hypothetical scenario that using this technique you will get, for example, that at a current price of $140 per share, you will get 5% annual compound returns for the next 10 years. So really, that would be an interesting insight that you can get with that result, because that means that the stock market price of Apple right now is not cheap, because you are getting just a 5% annual compound return. So that means that with that information, you could decide that you should wait for a further decline of the stock market price of that stock in order to increase your compound annual returns for the long term. So in this book, you will learn how to calculate your long-term returns, for example, making projections of the earnings per share, the dividends per share, and in that way you will be able to calculate your compound annual returns given the price that you want to pay for a certain stock. So really, if you want to know more about that, I mean, I've just made one video in this channel in which, well, I'm explaining to you with detail, step by step, using a spreadsheet in Excel, how to calculate your compound annual returns given the price that you want to pay for a certain stock. In that particular case, I'm using the example of Apple stock. So I'm sure that that video could be an excellent complement of the information that you will learn in this interesting book. So really, I would recommend to read this book to learn how to learn that important technique that I'm sure that could be useful for the management of your investment. And of course, something really interesting is that once you learn how to calculate your compound annual returns of your investment in each of the stocks that are part of your portfolio, you can get compound annual returns of your entire portfolio. So given the fact that you have previously calculated your compound annual returns for each of your positions that are part of your portfolio, and putting the respective weight that they have in your portfolio, you can calculate your compound annual returns given the price that you already pay for each of those positions. In cases in which you have made different purchases in one stock, you can consider the average cost in order to calculate your compound annual returns of your entire portfolio. So you can get interesting insights from the technique proposed in this book, really. Well, the fourth book that I want to share with you is The Five Rules for Successful Stock Investing from Pat Dorsey here. This is a Morningstar guide. This is just the Spanish version. And well, in this book, you will find interesting information. Probably the most complete book of stock investing that I ever read in my career, really, because you will find information about how to make a proper assessment of any stock in which you want to invest. And the important thing to understand is that in this book, you will find information about what are the most important accounts within the balance sheet, the income statement, the cash flow statements, in order to discover value. That will help you, of course, to understand if the company that you are assessing is really a high quality one. Another interesting point is that the book will tell you how to calculate your intrinsic value using the discounted cash flow methodology, and then the book really will provide you with different examples. I'm sure that it will be so much clearer for you after reading this book. And probably, well, the most important part of this book is the third part, because in the third part you will find important information respect of the metrics and the most important characteristics of the different industries that are part of the market. For example, you will find in the most important metrics or how to calculate intrinsic value in the insurance businesses, in the insurance industry, or in the banking system, because you know that you cannot use the discounted cash flow methodology to calculate intrinsic value in the companies that are part of those industries, because the value creation comes from other sources. they do not come from the cash flow generation. So you will learn all these things there in this book. Aside to the fact that there are other important industries that this book covers, for example, the software companies, the oil and gas companies, retail companies, and among other different industries in which, well, you will find what are the most important metrics, the important characteristics that you will need to take into account if you want to invest in the companies that are part of those industries. So I would say that this book is a must for everyone who wants to learn more about the assessment of different companies, of different industries. So I would say this book should be a must in your library here. Well, the next book that I want to share with you is The Warren Buffett Way from Robert Hackstrom here. This is the book here. I just found this book while walking in Manhattan, New York, and I just got into a library and I just found this amazing book, really. Well, in this book, you will find interesting information in the first part about all the different investors or super investors who truly influence in the way of thinking of Warren Buffett. For example, Benjamin Graham, John Burr Williams, Charlie Munger, Phil Fisher, John Maynard Keynes, and so forth. So you will find how those super investors truly thought about investment and how they influence in the way of thinking of Warren Buffett. The second part, well, it was really interesting because there are 9 different cases, 9 different stocks in which Warren Buffett has invested in his career. For example, in the case of American Express, Wells Fargo, Coca-Cola, General Dynamics, and so forth. And you will find interesting information and characteristics that truly attracted Warren Buffett. So really, the book will tell you how Warren Buffett was thinking about all those stocks, and the book will reveal to you what has been the intrinsic value previously calculated by Warren Buffett to decide to invest in all these stocks, really. So this is the most unique part of this book, that it will tell you how really Warren Buffett was thinking about them in order to decide to invest on them. And the third part, well, there are different kind of information with respect to different experiments about portfolios, about the psychology of the market, how the psychology behind the stock markets and so forth, supporting those subjects or those matter with different studies. But for me, the important matter that I truly remember about this book in the third part is the portfolio management. I mean, the book really will tell you how to outperform the returns of the market, just concentrating in your most important positions here. That's why it is important to gain confidence, to study pretty well the companies in which you want to be invested, and of course, considering that two, three, or four of your stocks need to represent at least 50% of your total portfolio. Probably, you will think that your portfolio will have so much volatility over the long term compared to the market, but in the end, you will surpass the returns of the returns of the market, because, well, when you have a high conviction in those stocks, honestly, you don't need to be really well diversified. This is particularly a suggestion for those investors who truly knows how to assess the different stocks, how to assess the different companies, the different industries. So for them, the most important recommendation is to concentrate in their investments. For those who are starting in this business, in this field, it is not recommended to have a portfolio well diversified. It would be best to have an index fund instead of you trying to make your own portfolio well diversified, because in the end, most likely you will get lower returns than those returns of the market, really. So really, this is an important part of the book, because the book will tell you how to concentrate your portfolio in order to outperform in the market. It doesn't matter if your portfolio will have a higher volatility than that of the market. So really, this is a really truly recommended book, and it need to be a must in your library here. So the next book that I want to share with you is The Damned Investor. You know that this was written by Monish Pabrai. You know that Monish Pabrai had the opportunity to win an auction to have a dinner with Warren Buffett, and, well, he had the opportunity to speak directly to this super investor in a dinner, and of course, according to Monish Pabrai, that was a turning point in his career, really. Well, to understand a little bit more about the damned investor, really, we need to understand what does the word dando really mean? The dando word is an Indian word that means activities that create wealth. Okay, so you can imagine here what you will find in this book, different examples about how to make investments, just investing in a small amount of money in order to get interesting reward for our investment without with the possibility of losing our money, but given the fact that we have invested just in a small amount of money, our risk is really limited here. So all these examples are based on that premise. I remember the first examples of this book. For example, an Indian family who came from India to California in the 1960s, and then well they started a business related to the motels. They bought a motel with just a small amount of money, and the rest of the money for the investment was asked to the banks through our loan. That and way the guarantee of that loan would be, of course, the motel. So the probabilities of losing, of course, were rather limited because even if they fail in their business, they would lose, of course, the small amount of capital invested. And given the fact that if they would lose in that scenario, of course, the bank would take the motel as a guarantee. But if you notice here, when you are investing a small amount of money, you are facing a lower risk. Okay, this is the most important thing about the tandem investing style. Well, the thing is that this Indian family were successful because in the end they had an investment philosophy really in their mindsets of offering us adequate services at a way cheaper cost than their competition. And that was important to attract more customers, more occupants to their motels. And given the fact that they were saving a lot of money in terms of cost and in their way of life, they started to build up really wealth over the years, and they started to make more acquisitions of more motels, and in that way they built up an empire, okay, over the years. Another interesting example was related to Richard Branson. I mean, according to this book, Richard Branson discovered that the airline companies were not serving well the flights between London and New York. So he discovered that there was an opportunity to get into this business. But instead of thinking of buying a new aircraft, which would have been, of course, a huge investment, he reached an agreement with Boeing in order to rent one of its aircrafts. And in that way, Richard Branson got into this business with just a small amount of capital. Of course, his risk was really limited here as well. So he was using or applying the Dando investing style. So you will find interesting information here, but I want to share with you with some of the principles of the Dando investor really. For example, you will need to be focused in buying an existing business instead of trying to found a new company from scratch, because that would be, of course, riskier. If you buy, for example, a company that already existed, you will face less risk. You can imagine, for example, when Warren Buffett uh, uh, bought the shares of Berkshire Hathaway when it was a textile company. So really, he was buying a company that already existed. Okay, so he was facing a less risk investment. Okay. Another principle is to buy businesses that are easy to understand, businesses that do not face potential changes in their technology. This is important to understand because this is one of the main reasons why, for example, Warren Buffett does not like to invest in tech companies that will face changes in their business model, changes because their competitors or their industry is requiring those changes. And one of the main reasons for that avoidance is because we don't know honestly how much capital will be required just to keep the company in the same position as it was in the past. So in those scenarios, the company is not invested to create more value for the shareholders. It is just in reinvesting to keep it the same market position that it had previously to that change. So this is the worst enemy, of course, for a long-term investor. So it is preferable to stay in businesses that are easy to understand and that do not require these kind of changes in their technology, really. And another principle, because there are so many principles, but you will read about them if you buy this book, is to buy companies that are facing difficulties in their respective industries. You know that if you have previously identified different excellent companies with an outstanding managers, companies that have the power to set higher prices, and you find that these companies are facing some kind of temporary setback. For example, you can imagine, for example, what happening with the travel and tourism sector after the COVID scenario. So the travel and tourism sector is one of the most affected companies from the whole companies, from the whole industries. And if you have discovered a high quality company in that sector that do not require so much capital expenditures, that do not require so much financial leverage, but just it is just experiencing this kind of temporary setback, not because of its business model, but because something that is affecting the whole industry. So those could be an opportunity for example, to get into these companies. And if we have patience, we can wait until this temporary setback ends really, and we could expecting, of course, an interesting capital appreciation for our money really. So you can find interesting information in this book really. Monish Pabrai is managing the Pabrai funds based on what Warren Buffett has done with its Buffett's partnership here. He collects the fees in the same way. I mean, Monish Pabrai collects have the same structure as Warren Buffett had with the Buffett partnership in the 1960s. So really interesting to know more about the Pabrai funds and how really a Pabrai fund or Buffett partnership really established set or a structure of fees for the participants that are way different from all those structural fees collected by many investment funds in nowadays really. So I would say that this book really is a must in your library for any value investor really. And the last book that I want to share with you is this one, Warren Buffett and the an Interpretation the Financial Statements, written by Warren Buffett and David Clark here. So I think that this book is really easy to understand. I mean, because the book will tell you how to read the balance sheet, the income statement, and the cash flow statement, how to understand the equity, and really, well, I think that this book will could be as a solid base for you, because in order to know how to really read the annual report, the financial statements, you need to practice so much reading different financial statements of different companies in different industries. But I think that this book could be a really solid base to start with. You need to remember that in my previous video about Hewlett Packard, you can watch that interesting video. I needed to solve a problem because in Hewlett Packard, it was delivering negative equity several years ago. So I need to understand what's going on with that negative equity, and I needed to know if really negative equity was really a concern from an investor point of view. So really, with reading this book, it was really helpful, and I just explained to you in that video how I solved that problem using this book. This is just the first group that I developed for this video. I will make other videos in the future respect to all many other books. I will include, of course, the security analysis, the intelligent investor, the snowball, of permanent value, which is the book that I have behind here. So many books that come in really within the value investing. So I hope that you really have enjoyed this video. Please put a like if you consider this is a video that is adding value to your investment knowledge. Consider to subscribe. To subscribe is really for free, and consider, of course, to share these kind of videos with a colleague, with a friend, because I think that these videos could be really helpful for them. So I hope to see you in the next video. Peace.